Oil prices fell more than 2% in yesterday's session. Investors are concerned that central banks may not be done with interest rate hikes. And this basically means that there's likely to be a continuation of the recent drawdown in demand. I want to show you the chart here. First of all, for US crude, you can see it bumping along the bottom here, not too far away from the line of support at 66.95. We are at the moment, early part of the trading day today, on this Wednesday at 68.02. If you get a candle close below here, the next line of support is then the lows that we had back on the 2nd of May at 63.76. Yesterday, the European Central Bank President Christine Lagarde confirmed that unless there is a substantial change in the inflation outlook, the central bank will continue to raise rates in July and thereafter as needed. Meanwhile, in the US, consumer confidence rising to an 18-month high this month, suggesting the Federal Reserve will likely have to continue raising rates to slow demand. Last week, you'll remember Jerome Powell, the chairman of the Federal Reserve, coming out saying the market should expect 2 more rate hikes by the end of the year, 25 basis points each meeting, according to market expectations. The Fed chairman due to talk at the ECB forum in Sintra today. Meanwhile, the API inventory data out yesterday had no impact whatsoever on oil prices. Crude oil stocks falling by around about 2.4 million barrels. Gasoline inventory is down by about 2.85 million, and distillate stocks rising by around 800,000 barrels. But the big news in the oil sector is just how much demand could well shrink if we see a continuation of interest rate rises, which continues to impinge on the amount of money in the markets.